Hi, I'm Brian Moody with Remnant Finance. In this short video, I want to give like a 30,000 foot overview of just what is the infinite banking concept. I think we'd be remiss if we didn't initially identify the problem with why we want to practice the infinite banking concept, or IBC for short. One is just as a general savings. The savings rate in America is abysmal. In March 2024, the last full month we have data for, it was 3.2%. So before we think about investing, we need to have a great place of saving. But beyond that, I want to talk about what Nelson Nash said, the father of the infinite banking concept, in his book, Becoming Your Own Banker. We finance everything we buy. You either pay interest to someone else or you give up interest that you could have earned elsewhere. And there are no exceptions. And so IBC helps us solve this problem of giving up that interest and having a constant compounding of our money, whether we're using it to save, to spend, or to invest. So everybody has an income of some sort. Maybe that comes from a job, maybe that comes from a business, rent, royalty, interest and dividends. It could be a retirement income, maybe an inheritance. And as that money comes in, there's really only about four things you can do with it. You can spend it, you can save it, you can give it, or you can invest it. And the big thing is that our wealth has to reside somewhere. It starts somewhere, it goes somewhere, it sits and it moves through some vehicle. It's got to reside somewhere. And the environment in which we do that, it really, really matters. So what Nelson showed us is that the best environment to save our money is participating whole life insurance from a mutual company. Now, you've probably heard somewhere along the way that that's a terrible place to put your money. It's a terrible investment. Well, I just want to say it's not an investment. It's better compared to a savings environment, but it completely optimizes the way that our money is used and the way that our money accumulates. And so I'm going to call that our family bank. That would be the whole life insurance policy where we keep it. We're going to put that into a participating, means it pays dividends, mutual whole life insurance company. And it's going to provide us with guarantees and death benefit and cash value, a guaranteed level premium payment. It's going to give us all kinds of tax incentives. There's going to be an income tax wealth transfer down the road. That's the death benefit. It'll grow tax free, technically deferred, but if we use it right and build it right, it'll be tax free. And we're going to have tax free access to that money. It's going to give us uninterrupted compound growth, even when we leverage that money through the flexible loan provision, which is what really makes this powerful. We're going to have absolute control of our money in our whole life insurance contract. It's going to earn dividends and interest forever. Someday it can provide us future passive income if we need it to or if we want it to. It's not going to experience any market volatility. It's not tied to the S&P, to the stock market, or any of that. It's more equivalent to a high yield savings, but it's going to be truly be high yield in any environment. It's going to provide asset protection, especially in our later years. It's going to give us creditor protection in most states. It's going to provide a potential for an accelerated death benefit. So if we become terminally ill, we can access some of that money early on. And it's going to give us the possibility to complete our savings program if we qualify for disabled waiver of premium. So how could it work? How does IBC exactly work? I want to illustrate this kind of in some possibilities. It is the infinite banking concept, means it can work in infinite number of ways, but here's a couple ideas of how it works. So your income is going to initially pay a premium to that mutual insurance company. And over time, that premium is going to act just like a mortgage payment to a house. Every time you pay a mortgage payment, you get a little bit of equity in your house. Every time you pay your premium, you're going to get equity or cash value in your whole life insurance contract. And the difference is we're going to get a lot more equity a lot faster, especially the way we design it in whole life insurance, than you likely will with your mortgage. And we can eventually access that cash value like a line of credit. So this is going to be comparable, not equal, but comparable to a HELOC or a home equity line of credit. So now we need to do something. We want to buy something, we want to invest in something. So we're going to ask the insurance company, our mutual insurance company. We're going to say, "Hey, I want to borrow some money. And they're going to look at our cash value and say, do you have enough? And if our request is inside what we have in cash value, they're simply going to put basically a lien against that portion of the cash value and loan us the money. And then we're going to take that money and we're going to do the purchases we want. Maybe we want to buy a car. Maybe we want to pay for a kid's wedding or our own wedding or college for somebody. But what we used to do was send that money out the door to a bank. We'd send payments, we'd send interest, and the banker would get rich. We're not going to do that anymore. Now, what would have gone out the door to the banker, we're just going to send back to the mutual insurance company. And what they're going to do is every time we make that loan repayment to the insurance company, they're going to reduce the lien on our cash value. So just like a line of credit, we have access to that money again immediately. And as that money grows, maybe we start expanding and buying assets. And that's when things get really cool. So the next loan, maybe we buy a piece of property. And what does a property do? Hopefully, one of the things it does is it cash flows. Well, that cash flow comes back to us and we have options on what to do with it. If we're smart and we're being a good banker, we're going to pay back that loan to the mutual insurance company. And again, it's going to be accessible to us via our cash value loan provisions. Maybe the next thing, perhaps we want to make an investment in hard money loans or oil and gas. It's limitless what you can do. And it's up to you and what your investor DNA is. That stuff's going to cash flow back to you, and you're going to do the same thing. You're going to send it to the mutual insurance company. They're going to apply it to the loan balance, and you're going to have access to that money again, recapturing the interest costs instead of making a bank rich. All of this is staying inside your own eternal economy. Maybe you want to use it in a business. Well, your business hopefully cash flows. So the same thing, that's going to come back to you. You're going to repay the loan. You're going to rinse and repeat. And what's cool is the whole time that money is growing inside the policy. It's earning interest, it's earning dividends, it's earning a rate of return, even while it's outside doing another job. And if you've done some smart investments, that money's doing all kinds of jobs. Maybe it's cash flowing. If it's real estate, it's getting appreciation, amortized equity, tax incentives, and even more benefits. So essentially what it's doing on that side of the column is it's earning a rate of return. So your money's earning a rate of return in the policy and in the investment. And we call that the velocity of money multiplier, which getting our dollars working in 2, 3, 4, maybe even 5 places at the same time can really accelerate the wealth building. If you have any more questions, I suggest you get the book Becoming Your Own Banker by Nelson Nash. Reach out to me. I'd love to chat with you. And I hope this helps.